It's 11:45 on a Tuesday night in Nashville. Derek is 40, single, and just left a downtown bar. The second he steps inside, the sky absolutely tears open. Rain hammering the windows, thunder rattling the glass. Perfect timing. He drops onto the couch and pulls out his phone. Not to check the weather, to check one single stock: Netflix. He texts his girlfriend 6 time zones away. Buying 300 more. Add yesterday's buy, and that's 450 shares total. 450 shares. Roughly $33,000 at tonight's price. Here's the part that should make your palms sweat a little. Netflix reports earnings tomorrow, after the closing bell, hours away. Good news, the stock hasn't been this cheap in 2 years. Bad news, it's cheap because something might genuinely be broken. I've watched people make this exact move for 15 years. Some got rich. Some got a very expensive lesson instead. So tonight, one question: genius move or expensive coin flip? First, you need to understand who Derek actually is. He bought his very first index fund at 18 years old. 22 years of investing through crashes, bubbles, and recoveries. Today, $3.5 million sitting in his portfolio, plus $13,000 a month from a job he's good at. This is not a guy betting rent money on meme stocks, which makes his Netflix decision more interesting, not less. Because experienced investors make one very specific kind of mistake. They stop asking questions right when the questions matter most. So what exactly is Derek buying tonight? Let's actually look. Netflix closed around $73.75 today. That's down more than 40% from last summer's all-time high. The peak was $133 back in June last year, so the stock got cut nearly in half. Here's the strange part. It's not because revenue fell. Revenue grew 16% last quarter, $12.25 billion of revenue. In one quarter, the company even raised its free cash flow target to $12.5 billion. So the business grew while the stock collapsed. Both things happen. Here's what actually spooked the market. One word: engagement. People are watching slightly less Netflix per subscriber than before. And YouTube keeps eating everyone's attention, one short video at a time. Netflix also stopped reporting subscriber numbers entirely this year. Markets absolutely hate it when companies hide their report cards. Then Netflix walked away from the giant Warner Brothers deal. Walking away cost them a $2.8 billion break fee. Stack it all up: fuzzy engagement, a failed mega deal, nervous analysts. Morgan Stanley just cut its price target from $115 to $90. Barclays went lower, $85. The street is getting cold feet. And into that exact storm, Derek is buying. Aggressively. Tonight. Quick pause. If you like honest breakdowns like this, subscribe. Now here's why Derek's rainy Tuesday night matters to you. Every investor eventually faces this exact same setup. Every single one. A quality company. A crushed stock price. Earnings tomorrow night. Do you buy the dip, wait it out, or walk away completely? The uncomfortable truth: cheap and safe are not the same word. Netflix trades at 23 times trailing earnings right now. Its own 5-year average? Around 39 times. Much higher. By its own history, this stock is on the discount rack. But discounts exist for reasons. Sometimes very good reasons. The market is really asking, is Netflix still a growth story or a mature company that should trade like boring old cable TV? That single question is worth more than any earnings beat. So let's build a real framework instead of a guess. Lens number 1. Figure out what's already priced in. A stock price is just a big bundle of expectations. Wall Street consensus expects 79 cents per share tomorrow night. Revenue around $12.6 billion. Up 13.5%. Netflix already warned this quarter's margins would dip. Content costs. They pre-announced it back in April. It's on the record. So a margin dip tomorrow isn't news. It's just confirmation. The real surprises live outside the headline numbers. Watch the ads. Ad revenue is on track to roughly double to $3 billion this year. Over 60% of new signups now choose the ad-supported tier. If advertising accelerates, the whole bear case starts to wobble. Now apply this lens to Derek's own history of buying. His best purchases came when expectations were on the floor. His worst? When he paid for perfection and reality showed up. Tonight, expectations for Netflix sit unusually low. That's genuinely notable. Analysts still average $113 as a price target. That's 53% above tonight's price. A massive gap. Someone is wrong here. The market or the analysts. Pick one. Lens number 2. Respect the coin flip. Earnings night is chaos. Options traders are pricing an 8% move tomorrow. Either direction. On Derek's $33,000, that's about $2,600 overnight. Historically, when Netflix misses, it drops almost 10% that day. And when it beats, sometimes it still drops anyway. Barely positive. Read that again. Winning the quarter doesn't guarantee winning the day. Earnings night rewards guessing expectations, not understanding businesses. Derek isn't buying a quarter, though. At least he shouldn't be. If your thesis needs tomorrow to go well, it's not a thesis. It's a lottery ticket wearing a spreadsheet costume. Ask the honest question. Would Derek buy if earnings were next year? If yes, then the timing is drama, not danger. If no, he's gambling and calling it conviction. Big difference. Lens number 3. The size of the bet decides everything. 450 shares sounds aggressive. Sounds like huge conviction. Now actually do the math against his $3.5 million. $33,000 is less than 1% of Derek's portfolio. If Netflix drops 30%, Derek loses about $10,000. Painful? Sure. Life-changing? Not even remotely close. Now imagine that same trade at half your net worth. Completely different decision. Same stock, same night, different risk. This is the part beginners always miss when copying investors. They copy the ticker. They never copy the proportions. A 1% position lets Derek be wrong calmly. Position sizing is what separates an opinion from an emergency. So, buy, sell, or fairly valued? Here's the honest map. The bull case. Real revenue growth, ads doubling, a historic discount. The bear case. Engagement slipping, YouTube rising, the growth story aging. And fairly valued? Only if Netflix becomes boring. It genuinely might. Back to Derek's couch. The rain is still hammering the windows. His girlfriend replies from across the ocean. You sure about this? He types, deletes, types again, finally sends, we'll see tomorrow. And honestly, that's the most accurate investing sentence ever written. Notice what Derek did right and what he did wrong. He bought a business he's followed for years at a discount. He sized it so disaster costs him sleep, not security. But he also bought hours before a binary event. Pure impatience. Waiting 2 days would have cost him nothing but suspense. Tomorrow's information is free. He simply chose not to wait for it. So here's my question for you, and I genuinely mean it. 450 shares the night before earnings. Smart or reckless? Drop your honest take in the comments and defend it properly. Would you buy tonight, wait for the print, or skip entirely? There's no consensus answer. That's exactly why it's worth discussing. The lens to keep. Cheap is a fact. Value is a judgment. Expectations, coin flips, and sizing. That's the whole toolkit. It works on Netflix tonight and every earnings season forever. Quick reminder, this is educational content. Pure sharing, nothing more. Nothing here is financial advice. Talk to a professional before acting. I don't know what Netflix prints tomorrow. Neither does Derek. But now you know how to think about it. That's the edge. If this helped, subscribe for more honest breakdowns like this one. And when Netflix reports, come back and tell me who was right.